The views expressed on this podcast are those of the participants, not of Reuters News.
Treasury yields edged higher, with the benchmark 10-year note yield touching a 14-month high above 4.8%. Markets are currently pricing in one rate cut from the Fed this year, as inflation remains above the central bank's target and the economy continues to grow at a healthy clip.
Yields on long-dated British government bonds are at their highest in decades. That's put government finances under pressure, while sterling is struggling and British domestic stocks are underperforming.
Bond yields are surging across the UK, Europe, and US. Investors are fretting about President-elect Donald Trump's policies around tariffs and tax cuts, which could drive up debt and inflation. While in the UK, there are concerns that the country's finances are not under control. How this unfolding situation will play out and how it could influence policy is the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with Breakingviews columnists. And I'm your host, Aimee Donnellan.
And I'm Jonathan Guilford. Aimee, obviously from the US, I guess what I feel when I'm looking at this is there is a line that is the 20-year yield. It keeps flirting around that 5% mark, despite the fact that we've had multiple Fed cuts. We have an administration that's coming in that is obviously, wanting to go very big on tax cuts, and a lot of a kind of policy menu that's getting passed around the incoming Republican caucus of offsetting spending cuts that seem probably a bit out there in the realms of political plausibility. Everybody's kind of freaking out about this. There's a question of, is the bond market finally seeing, the advent of the vigilantes? Will this begin to kind of impinge on US fiscal space? But of course, over in the UK, it's getting even more acute than that, right?
It is indeed, yeah. And again, for different reasons, but there is a concern, as I said, that it's whether the UK has its finances under control, and investors seem to be reflecting that in the bond yields that are going up in the UK, which is ending a very, very brief honeymoon that Keir Starmer, the new Prime Minister of the UK, had, and Rachel Reeves, his Chancellor, which is the Finance Minister of the UK. So they've come in very different, obviously, from the previous government, which was in power for a very long time. And I think people were quite hopeful that there would be change. And this does seem to be quite a distraction, to the point that there are certain newspapers in the country that are questioning whether Rachel Reeves will actually even, whether she will last as the Chancellor. So, but luckily we have two very bright-minded credit experts with us. We have Francesco Guerrera, Global Economics Editor of Breakingviews, and Gabriel Rubin, who is our Washington, D.C. correspondent. So welcome, Gabe, and welcome, Francesco.
Good to be here.
Great to be here.
So, Francesco, I think probably an overview is needed here, right? So we're seeing bond yields, as Jonathan said, on both sides of the Atlantic going up and causing quite a bit of concern as to what is going to happen, how that might shape policy. Is there any sense that this is temporary, that this is a reflection of just uncertainty? How are the people you're talking to, how are they interpreting all of this?
Well, I think it's important to establish the sequencing of events here, because it all started in the US. The US bond market, being the biggest, the most liquid, the most important, is the one that sets the tone for the rest of the world. And in the US, as Jonathan was saying, we've experienced a sharp rise in yields, especially at the long end of the curve, so the ones, the 20-year, the 30-year bonds. And that's been driven largely by the uncertainty over President-elect Trump's new policies, and that there's a fear here that there will be an increase in the debt load, and there's been a fear that that would also could be inflationary. And so those are things that obviously the bond market doesn't like, and when they don't like it, the yields go up and the prices of bonds go down. Then that spilled over outside the United States, first of all in Europe, in continental Europe, but mostly in the UK. Now, in the UK is a specific case in this particular instance, because the UK's sharp rise in bond yields. The 30-year bond yield in the UK reached a level which was the highest since 1998. So it's a very historically high level. Bond yields in the UK have been driven first and foremost by the rising US yields, because as we said, they set the tone. But also there's issues, UK-specific issues. In particular, there is, as you mentioned, the fear that the UK doesn't have its finances in order and will have to issue more debt to fund its increasing deficits, or make spending cuts, which is also not good for the bond market. So there are specific issues here which the government will have to address. Now, the government has a bit of time to address it, because the next time they have to opine on fiscal policy is not until March 26. But on March 26, they might have to say that they need to do something, and that something is either tax hikes, which will be politically unpalatable, and also they promise that they will not do it, or spending cuts, public spending cuts. And anybody who lives in the UK will tell you that the UK is not ready for public spending cuts because of the state of its infrastructure. So the UK is in a particular predicament now, and it'll be very interesting to see how the next few weeks develop, because it could precipitate action by the UK government.
Got it. And I mean, pulling this back to, like you say, this kind of like started in the US. I don't know if, Gabe, like, do you have a view from the folks you're speaking to on what exactly it is investors are worried about when it comes to the Trump administration? Obviously, like, we have a lot of policy proposals on trade, on tariffs that could disrupt the functioning of global markets in various ways. But it seems like this is like a sharper concern about maybe the fiscal picture or what's going to happen in terms of the path of Fed rate cuts. Like, do you have a sense of what's predominating here?
Yeah, the problem is that basically everything in Trump's agenda is directionally inflationary. You have a trade policy that is completely focused on the utility of tariffs, and tariffs, of course, function as a tax on consumers within the U.S. For imported goods and things that use imported materials. So if you have a perhaps 20% or perhaps 60% tariff, we don't know exactly where we'll end up, but on as a general tariff on top U.S. trade partners like Mexico and Canada and China and the EU, you would end up with a massive inflationary boost, which over time, would keep bond yields high. And especially that's why we're seeing in the long-term bond yields, more worries about higher prices and higher inflation. The other side of things is that Trump's main priority this year, and Republicans in Congress's main priority this year, is getting a major tax deal done, which would extend and broaden the tax deal that was passed in 2017, which was sort of the primary legislative accomplishment of Donald Trump's first term in office. The numbers here are quite stark. Simply by extending the existing tax cuts that need to be extended, or else they will expire at the end of 2025, would cost upwards of $4 trillion. And if you add in the other elements that Trump is suggesting, no tax on tips, exempting Social Security, that's the pension system in the US, exempting that from income tax. I mean, once you add all these things together, that ends up being, according to some estimates, nearly $8 trillion over a 10-year period. Now, some of that will, of course, be funded via revenue-raising things or canceling previous tax cuts, like the ones that were contained in the Inflation Reduction Act, things for green manufacturing, consumer credits for things like electric vehicles. So that, of course, will be on the other side and will raise revenue that will counteract the effect of those tax breaks. But Republicans are a cut taxes type of party. They don't like raising revenue. They don't like raising income taxes, certainly. So if there's no revenue to balance out these massive, massive fiscal outlays, either in the form of spending or in the form of tax cuts, the result is that there's going to be a lot more debt and a lot more deficit spending, a lot more spending that bond markets will then have to contend with, which means much longer term high rates.
And Gabe, how would you like kind of characterize, how would you explain that there's such a disconnect between the equity market in the US? Now, I know that has obviously come down, but it was fairly buoyant, and the sort of bond price reaction that you're seeing there. So why is there, if you do have this like soaring debt, very high borrowing costs, how does that not impact the rest of the economy?
Well, I think the answer is that it ultimately will, and I think that some of the initial euphoria after Trump's election, has faded in these equity markets. Now, I think obviously the projections for 2025 and in coming years, still show pretty high, pretty high valuations in equities. But so I think that sort of shows that there's an expectation of high productivity growth. There is an expectation that Trump and his advisors care so much about the stock market as an economic indicator that they are going to pull back on some of these plans, and they will, not take on all this unfunded debt that they say they will, or impose tariffs in quite the way that they say they will. So there's definitely a disconnect there where equities have not fully understood the cost of Trump's policies and are only looking at the positive side of things. But if this recent pullback in equity markets is a harbinger of things to come, then maybe they will be more aligned and they will be more gloomy about the economic future and the high cost of credit.
That's what I kind of wonder here, because it's like there are two forces pushing against each other. You have the bond market, where we recently published a prediction saying that the bond market could temper some of Donald Trump's more extreme policy ideas. But like you say, Gabe, a lot of those policy ideas should add fiscal impulse. They should potentially underwrite kind of higher expectations in the equity markets. Now, Donald Trump, if I'm thinking about what he's like as a guy, I'm imagining he's looking at the S&P 500 index more than he's looking at bond yields in terms of a validator of success. And I'm just wondering if, Francesco, maybe you have some perspective here on this rise in bond yields. Realistically, what is the constraint here? Does this kind of interplay mean that we're just going to whipsaw back and forth, or are there kind of spillover effects from the bond market that are just going to overwhelm either U.S. capacity to embark on policy as it wishes, or kind of spilling to the rest of the world?
Yeah, it's a real paradox, which we can explain, but it's still a paradox that the biggest rise in yields is happening and it started in the US bond market, but the immediate negative effects, the worst effects, will be outside the US. And that's because, to explain the paradox, that's because the US has the advantage, the privilege of having the world reserve currency in the dollar. So the dollar acts as a shield against that. Because why? Because people, companies, investors need the dollar to trade, and therefore there will always be a demand for dollars. That puts somewhat of a cap on the negative effect of this big rise in bond yields. Is not infinite. It's going to, at some point, as Gabe was writing his prediction, at some point the bond vigilantes are going to have their day. So, and we don't know when, so there's always a risk. But in the meantime, think of the dollar when it comes to global trade. Think of the dollar as the oxygen of global trade. When the dollar rises, there's less oxygen in the economic ecosystem to trade, essentially. And that is going to have negative impacts on all the economies that rely on the dollar. So particularly emerging markets economy, whose currency are mostly linked to the dollar, either formally or informally, but also, as we are seeing, in the United Kingdom, in Europe. And this is going to be an effect that we will see in the coming months. But we weren't expecting this, right? Remember that at the beginning of the year, everybody thought that the Fed was going to cut rates. The dollar was finally, because it's been strong for a very long time, finally end this period of huge dominance, and things were going to reassert themselves in a more positive way for global trade. Actually, what we're seeing, because of what we just described, we're seeing another squeeze on global trade, another increased cost for companies, institutional investors, and just normal people who need dollars to trade. So that's an unexpected start of the year.
Wait, so sorry, just to be clear, does that kind of imply that, say, the more Trump kind of tries to push his agenda through the, let's say, the kind of keeping the genie in the bottle pressure from the bond market, the more he resists against that, that's going to have spillover effects that actually end up kind of curtailing policy freedom in the rest of the world. E.g., it's sort of like a negative relationship between how far Trump pushes and the situation in the UK or emerging markets or elsewhere.
That's right. So it's an economic outgrowth of American exceptionalism, right? Because if, as Gabe was saying, Trump's policies tend to be inflationary, in the short run, that's good for the US economy, right? The US economy is going to grow by more. There's going to be more economic activity. There's going to be, and obviously in the longer run, the Fed is going to intervene. Inflation is not good in the long run, but in the short run, that's going to be good. That what's going to mean is that the dollar is stronger, and then we get into that vicious cycle for the rest of the world that we just outlined.
And Francesco, if I could take you back to the UK, because again, it appears to be just sort of acute, I should say, in terms of what's going on with Rachel Reeves and the government and what I guess she's expected to do. That seems like there's supposed to be some sort of answer as to how bond yields are going to come down to allow them to do the things that they want. Is there anything that the UK government can do to sort of assuage the fears of investors that the UK does have its house under control, that it is able to, pay for the things that it needs to pay for and run the country?
They can do a couple of things. One is to talk, and they have been doing that. They've been saying that they're talked about their commitment to keeping the fiscal house in order. Now, of course, the bond market has eyes, so they can see that the fiscal house is not exactly in order. So, but they can try and allay the market fears by talking, and they've been doing a bit of that. They can then rely and hope that the Bank of England cuts interest rates. That eases the pressure, right, on the bond market. If the Bank of England, as expected, cuts interest rates. Now, the problem with the UK is that inflation has been particularly stubborn, and so it's a bit difficult for the Bank of England to cut interest rates as much as perhaps the government would like, and the Bank of England is, of course, independent. And then the third thing they can do, and also they have no real agency on this, but they can hope that sterling, the currency, keeps going down. Now, this is unusual. When bond yields go up, normally the demand for a currency goes up because the yield's more, and so in theory the currency should appreciate. But actually in this case, in the last 10 days, the sterling has been depreciating alongside the rise in UK bond yields. Now, if that were to continue, it would ease a lot of the pressure, because at that point it makes obviously the UK bonds more attractive to foreign investors because they're cheaper in sterling terms. And remember, a third of the UK bond market is owned by foreign investors, so it's hugely reliant on foreign investors to fund the government debt, right? And that would naturally release the tension. But again, that's not something that the government can control.
Right. And it's interesting because obviously, like, the second order effect of all this, like you say, is what ends up happening to the policy course for central banks. In the US, we've basically just seen a total reversal of expectations of what the Fed is going to do, right? We've pushed out, predicted rate cuts. We have a much more kind of like hawkish policy sitting over the economy right now. Gabe, I'm wondering, like, as investors continue to bet against those rate cuts in the near term, what is the effect likely to be on the U.S. economy beyond, let's say, the obvious stuff like private equity firms are going to struggle to get buyout debt or whatever, right? And also, I'm wondering if that leads to some more acute political crisis where you have Donald Trump not only pushing against the kind of realities of the bond market, but also, he's made pretty clear that he thinks the rates are too high, right?
Yeah. So if Trump pushes back on that by diluting Fed independence and wants someone who at the Fed who will push for a more dovish policy and lower rates, despite the overheating in the economy, that's a longer term fight over political influence over central bank decisions. But we could see that come to a head if the cost of credit is simply too high in the U.S. It's simply too high according to Trump. He may push to dilute that Fed independence. In terms of what it would look like in markets, the primary effect will be on housing markets and home purchases. We've seen very, very high, historically at least, since the 1980s. The mortgage rates where mortgage rates are currently is among the highest they have been since the early 1980s in the U.S. Which has effects on household purchases and that sort of driver of the economy. So in terms of the real economy, you're going to have people pushing back on their inability to afford long-term credit finance purchases. So whether that turns into a political crisis for Trump remains to be seen. But the high cost of credit results in bankruptcies in businesses. It results in less investment on the part of households. So does that create a near-term challenge, or does that just sort of make the U.S. less competitive over time? Remains to be seen.
It's a tricky time, I would say, to be leader on either side of the Atlantic, given, Gabe, I think some of your numbers were particularly stark. 8 trillion is the cost of some of the policies. The prospect of inflation, we didn't even talk about, like deportations and things like that. So, yeah, an interesting time, and I don't think we're gonna see much stability in the bond markets over the next while. So plenty more to write on. Well, thank you so much, Gabe, and thank you, Francesco.
Thanks for
Thank you,
having
Amy.
us.
Thank you, Jonathan.